down 49% in 2022. Is Airbnb stock a buy for 2023? I'm going to answer that question by the time this video is done, so stay tuned. I'm going to look at a few separate metrics to answer this question, so let's get right into it. The first metric I'm going to look at is quarterly revenue growth for Airbnb going back to January of 2021. And you could see healthy revenue growth for several quarters, 240% in the summer of 2021. Of course, that's compared to the summer of 2020 when the pandemic was still raging and few people wanted to leave their homes. Now, as that pent up demand for travel is kind of normalizing, Airbnb's revenue growth in its most recent quarter was 29%. However, I fully expect Airbnb's revenue growth to remain robust for the next several years, and I'll tell you why. Before the onset of the pandemic in 2019, worldwide demand for travel and spending on travel reached $1.5 trillion. Now that collapsed to 600 billion in 2020, rebounded to 950 billion in 2021, and in 2022 it's estimated to be around 1.1 trillion. So we're still, even after all of this recovery, we're still $400 billion below the level of 2019. And remember, inflation has increased the price level of everything. So adjusted for inflation, we're even further below that 2019 level. So I expect travel to continue rebounding over the next several years. It's not going to be like a light switch, instantly rebound back above those levels. And so, as people spend more on travel over the next several quarters and several years, Airbnb will continue to benefit from that pent up consumer demand. The next metric I'm going to look at is Airbnb's total assets and total liabilities going back quarterly. And I wanted to highlight this because one of my favorite things about Airbnb stock is its asset light business model. It doesn't own any of the properties listed on its platform. That means it doesn't have to pay hefty fees to build these resorts and hotels. It also doesn't need to pay to maintain them, right? Doesn't need to hire staff and all of that kind of stuff. So it runs on this asset light business model, which allows it to grow flexibly when customer demand increases. It's Airbnb's revenue could expand quickly along with customer demand, right? It doesn't need to um, when customer demand starts to soar, it doesn't need to say, oh man, let's go build this resort. That's going to take several months, maybe years to erect and have it be serviceable. No, it doesn't need to do that. When customer demand soars, Airbnb's listings theoretically will increase as people see that, hey, I could make a lot of money by putting my property on Airbnb. And so it's flexible model. It can expand when revenue is increasing, and then when revenue decreases, Airbnbs can shrink without suffering consequences, right? If you're a hotel operator and you operate the buildings, then even if customer demand falls or decreases, you still need to maintain those buildings. You can't allow them to fall into disrepair. So that's a benefit to Airbnb's model. And let's look at its total assets: 19 billion and its total liabilities of 13.8 billion. Interestingly, roughly 8 billion of its total assets are cash. So it's got cash on its balance sheet. This is especially good because interest rates are going up and Airbnb is going to be able to earn a few percentage points more in net interest income going forward because interest rates are higher on its $1 billion cash balance. So this is good news for Airbnb. And another metric I'm going to look at here is Airbnb's earnings per share quarterly, and going back to January of 2020. Of course, here's the crash when people canceled and stopped traveling. And Airbnb took a major write down, decided to say, all right, let's take advantage of these expense write downs right now, take the tax benefit. This was mostly a non-cash expense, and then its earnings per share have been rebounding very nicely hitting a record level of $1.79 in its most recent quarter. And again, for the same reason why I expect revenue to expand, I also expect Airbnb's earnings per share to grow nicely over the next several quarters to several years. Finally, the last thing I'm going to look at is its valuation. So, okay, we can all agree that Airbnb's prospects over the next few quarters are going to be really good, but is that priced into the stock? Is the stock really expensive? Because sometimes you'll have a stock that has good prospects, but it's so expensive that it's not worth buying. That's not the case for Airbnb. It's trading at a price to free cash flow of 17.5, which is the lowest, arguably, that it's been trading for going back all the way in mid 2021. And so the stock is not expensive either. So it's got good prospects. The stock is not expensive. I like that combination. And um, I will highlight though, one of the reasons that Airbnb stock is not expensive is because investors are concerned about how the business will react if the worldwide economy enters into a recession in 2023, which the likelihood continues to increase. So there is that risk with Airbnb stock that earnings and revenue might take a temporary hit if there is a recession in 2023. However, even including that and all things considered, to answer the question, is Airbnb stock a buy for 2023? I'm gonna say yes. Airbnb stock is a buy for 2023, factoring in everything we considered here. The benefits outweigh the costs, and I would recommend folks to buy Airbnb stock for 2023. All right, that's all I've got for this video. I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.